Hello, guys. Welcome to Traders Therapy Session. I'm your host, KRO. Without wasting any time, guys, let's just get into this video. We are running out of time. We are working on 11th hour. Remember, 2023 bus driver model should be finished before the end of 2023. So, in this video, we are going to discuss a fair value gaps, wicks, and specific order blocks. I attempted to answer this kind of questions by the following. What is a fair value gap? A fair value gap is an imbalance price between three candles, and a fair value gap for sell is called a CB, of which is a sell side imbalance, buy side inefficiency. And fair value gap for buy is called a BZ. That will be a buy side imbalance. That means the buy side is imbalanced, so sell side is inefficient. So the market will come down to that space and then offer back. It will offer the sell side up to that space, and then the buys can continue. So question number 2. Don't worry about this, guys. This will be answered as we go to charts, as you see them. But you need to carry out these notes. You need to understand what is it that I'm talking about. Maybe after watching the charts, you need to come back to this video so that it can make sense again. A fair value gap has 4 sensitive areas that you need to take care of. Take note of, I mean to say. Let's just try to make a fair value gap, even though it's going to take some time. We are not going to make a perfect market, guys. Let's say you have this 2, 1, 2, 3. Let's make this black. It doesn't matter the candles on a fair value gap, guys. Let's just try to make this thing black, this one black, and this one. I hope it doesn't take our time. And let's make it solid. What is the difference between these two? This is 59. This is 99. Okay, 59. Okay, guys. Sorry for taking time, but I think it will be better if I explain this using such annotations. Okay. And then let me have a wick right there. So I guess order block, you will see order block when we go there. We just don't want to. We said it's an imbalance of price between 3 candles. We have 1, 2, 3 candles. Let's name them. I'm just doing this justice so that people don't come back to us and say, no, we didn't explain this. This was supposed to, we were supposed to explain, do this and that. So then we have the second candle, candle number 2. Plus, I'm also allowing those who are new on TradingView to just to get the skill on how is being utilized out there. Then this will be candle number 3. It's an imbalance between 3 candles. Fair value gap for sells is called a CB, of which is this one for sell. It's an imbalance. You see these candles, market likes to balance price as it moves. But look at the low of this candle and the high of the third candle right there. this right here is what we call a fair value gap. And then we abbreviate as FVG. So guys, this is a fair value gap. And then this, because it's a downside, if, listen to this, how does it work? If fair value gap has four sensitive areas, of which I need to explain right here. Not this, guys. Sorry for that. This is a Fibonacci. And then I like to take that fair value gap right here. I just want to zoom in, guys. Others here are just a visual learner. So if you don't do this, they don't understand what you are doing. This is that we are zooming in. I cannot use a Fibonacci here, guys. Please, it will be small. It's like trying to draw parts of a wristwatch with a pencil. So look at the areas. I have 100%, 75%, forget 62% because it's OTE. I have 50% and I have 25 and I have 0 there. So this means a fair value gap has these sensitive areas. 1, let me not draw, 1, 2, 3, 1, 2, 3, and 4. Oh, because, sorry, it cannot rotate because I just mentioned the 0 there. But 4 quarters out of 100, you see that. This means it's 1, it's 2, 3, and 4. If price come, it will react here, 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 or there. Or let's just put it if it's not going to clutter. For certain people just to see. Some people might catch this thing later, guys. But it's going to disturb us when we come to the wick right there because I have to explain the wick. Okay, let me just put it here so that it's understood. We have 0, 25, 50, 75, and 100. Because I mentioned 0 is the reason why I said there are 5. So for price to react, so it means if price comes to this, of which it will be 25% because we are approaching it, sorry, we are approaching it from the back. It will be 25, 50, 75. So it can react either from 0 as it touch 25%, it can go 25% in and reject, 50% in and reject, 75 and or it can close right at 100% and reject. That doesn't mean that fair value gap is going to materialize. Depends on the fair value gap, what type of a fair value gap you have at that point. Please guys, follow on this one. So this is just a sensitive, even if the fair value gap is not going to materialize, but you will see price when it bounces off these areas, it will be so sensitive. When it reaches this, it will just give you a reaction to show you that this is a sensitive area. So a fair value, okay, if fair value gap is rejected, reject price, this and price move above the fair value gap, it goes above here. The initial swing high or swing low start to draw towards the fair value gap. Sorry guys for this. Let me understand the statement again. If fair value gap reject price, the initial swing high or swing low that started the drawdown, fair value gap needs to take out to consider the fair value gap valid. Okay, let me just explain the statement, please. When this rejects price on either 4 of the sensitive areas, this low price needs to take, it will be, remember that price from here, price goes to this fair value gap right here. and it rejects. So this low needs to be taken out. This low needs to be taken out right here. This low needs to be taken out right here, just to consider this as valid fair value gap. This is the minimum it can go to consider it valid, to consider this fair value gap valid. So this means to you, you take a trade using this. We're going for short. Price, you wait for price to come to this. This is the fair value gap you utilize. Where do you put your stop loss? Either on top of this candle or that candle. It's up to you, depending on price. Then your minimum target needs to be this low. In this case scenario, if you choose this, according to your price, this will be 1:3, but sometimes it allows you to choose this. This is what 1:7. Your risk to reward ratio. So this is the statement. This is what it says. Looking at the minimum target of the fair value gap is this low. Then you can go to the lows that you were looking for. Then number C, if fair value gap is violated and we get a rejection to the opposite side, that fair value gap should be called invasion fair value gap. Again, let me explain. Price comes into this fair value gap and violates it and comes retest it and goes back up. This kind of a fair value gap now is no longer called a fair value gap. Now we call this thing an invasion fair value gap. It means it is working on the opposite side. That's what invasion fair value gap mean, guys. Right? You need, guys, after seeing the practical videos, you need to come back here. This is where you obtain your foundation, because you need to know the science of whatever the model that you are trading. Then we have invasion fair value gap. Follow this. I will use this red line right here to illustrate everything that I'm talking about here. If invasion fair value gap is violated and we get a rejection to the opposite side, that fair value gap should be called invasion fair value gap. Oh, this is invasion fair value gap. I explained this. Sorry for that, guys. If invasion fair value gap on the later stage becomes violated and retest on the opposite side, let me explain this. Same example. Remember, once we violate here, this becomes invasion fair value gap. Oh, sorry. This becomes invasion fair value gap. Then it comes, maybe it does whatever it does, then it comes back here and retest. Then it goes for that low again. This is what the statement means. Then this becomes what? This becomes a Reaper fair value gap. What is a Reaper fair value gap? When the fair value gap was supposed to work, but instead it was violated initially. Then the price came back, and then when it comes back, instead of making this price invasion retest, it will only be invaded because of this violation. Instead of getting a retest to move further up, then what do we get? We get price coming, retest it on the opposite direction again. This one then becomes a Reaper fair value gap. It means it works the way it was intended to work, but on a later stage though. Then that's how I define a Reaper fair value gap, or that's how I conceptualize the Reaper fair value gap from what ICT has taught. So guys, we have talked about the fair value gap. This seems like it will be a long video. Then let's talk about wicks. We know this is a wick, the shadows, the tails of the candles. What wicks should I look for? Look for wicks that stand out in the charts, especially on the price swings, like this week right here. Let's say you have a price moving up, and the price, you don't have this fair value gap for this point, and the price comes back to, let me close the fair value gap. Guys, if you have a week like this, you see now, we no longer have a fair value gap. Let's remove this. Now we no longer have a fair value gap because this price is balanced by this price again. This overlaps. So let's say the price on the later stage, let's say the price on the later stage decides to come to this right here, decides to come to this area right here. Use it as the same as wicks are used the same as fair value gaps as a sensitive area to reject price. It means 25% you measure, the whole thing. Okay, let's take it from this area. This week you measure from 25%. The price will react maybe from 25% and bounce off. 50% bounce off. 75% bounce off. This on a weeks, they do happen. But for double tops to occur, of course, they do happen. We do see perfect prices, but when it happens, when I see a perfect price like this and it bounces off 100%, I know we are coming for this. This is a sell side liquidity already, relative equal lows or exactly equal lows. That will be your week. And then what are specific order blocks, guys? Is the last candle or candles in a price swing, follow this, in a price swing before the establishment of the new direction. Order block needs to be opposite candles before opposite candle or candles before new direction is formed. And then a high probability order. Okay, where can I find them? High probability order blocks takes liquidity and are found with the fair value gap at specific areas with a specific price action confirming your bias. What it means like, guys, we're going to spend more time like we initially expected. Okay, let's say I have this price now as green price moving up. You just close this here, and then I have another one. Guys, this is the reason why we have to prepare the slides before the presentation, because these things takes time. Okay, let me just make it a small candle so that it can accommodate this. Copy. Sorry guys for wasting time, but I feel that there's a need as I move and presenting this. I feel sometimes there's a need for presentation. Then you have a fair value gap, of which we are not going to argue. We explained what a fair value gap is. Let me just do this. Okay, then we have a fair value gap. I need to change the color of this candle. It will make my example easy. Okay, it's either one candle or candles for that direction. And then we took out liquidity. We have those relative equal lows here. We have sell side liquidity bottom. It took out, sorry guys, where can I find them? High probability order blocks takes liquidity. What is an order block? Is the last candle or candles in price swing. We have this price swing right here. In price swing before the establishment of the new direction. Last before the establishment of buy. Remember, we are buying. And then order block needs to be opposite candles before new direction is formed. This one are opposite candles before the new direction is formed. High probability order blocks takes liquidity and are formed with the fair value gaps as at specific times with a specific price action. And then price action confirming your bias. You are moving up, right? Then you have the fair value gap of which we talked about here. As price comes back here to your fair value gap, you utilize what? You utilize what you've learned about the fair value gaps, the sensitive areas. You put your limit, your stop loss either here or here, aiming to buy high. But what are the order blocks? You see 1, 2 candles, 2 bearish candles. These candles, to me, they will act as an order block because they took out the liquidity before the market moved high. Plus, there's a fair value gap. So, I would love to see this. Is the reason why we say specific order block, not just any other order block that you will find. Then we'll find an order block on continuation. That one we'll just have to call it out when we see it. But most of the time, maybe out of 20 pictures, 20 trades that I have saved for December, there are maybe 15 of these order blocks. So I prefer this. When I don't see this, then the probability of my trade becomes low. So guys, without wasting any time, I hope you gain more valuable lesson from this video. And then if you liked it, hit that like button. And then please, if you feel valuable from the information that we share, please subscribe and put on the notification bell there. And if you think that you can help others as well from what I do, please share the following video with other people so that we can bring more people in. Without wasting any time, guys, let me see you on the next and last video before I show you how these things works every day in real life.